Trump's crypto involvement didn't begin with a scandal or a breaking news banner. It began with numbers so large they should have set off alarms across the entire financial industry. In early 2025, a months-long Reuters investigation revealed that the Trump family had generated more than $800 million in crypto-related income in just the first half of the year. That figure didn't come from rumor. It came from documents, corporate disclosures, blockchain analysis, and filings from multiple jurisdictions. And to anyone in finance who understands how money signals intention, the meaning was clear. This wasn't a side hustle. It was a strategic move, one that had been building quietly in the background before the public even realized crypto had become part of Trump's financial universe. What makes the story significant isn't the income alone. It's the structure behind it. When you examine the pattern, you see a level of coordination that suggests long-term planning rather than spontaneous opportunity. Token ventures, digital asset platforms, strategic partnerships, foreign funding channels, potential offshore structures, and a deliberate push toward blending politics with blockchain-based finance. This was not a casual alignment with crypto culture. It was positioning, high-level positioning, inside a sector known for explosive growth, limited regulation, and unprecedented global liquidity. The most revealing moment came when Trump Media and Technology Group, the company behind Truth Social, announced a partnership with Crypto.com. The plan was to create a joint venture that would raise roughly $1 billion worth of CRO tokens, with a portion of that capital used to build a crypto treasury portfolio. To an untrained eye, this looked like a digital marketing stunt. But to finance professionals, it looked like something else entirely, an attempt to mimic institutional treasury strategy with digital assets. Corporations don't build crypto reserves unless they believe regulatory conditions will shift in their favor and liquidity will deepen. That move alone told the market precisely what was coming. Digital assets were entering the mainstream in a way no previous administration had ever attempted. Then came something even more consequential. In March 2025, the White House issued an executive directive instructing federal agencies to retain seized cryptocurrency and explore mechanisms for building a U.S. government digital asset reserve. The language was understated, but its implications were not. If the federal government begins treating crypto like a strategic asset, similar to gold, oil, or foreign reserves, it instantly changes the legitimacy of the entire digital asset class. It also introduces new regulatory structures, national security concerns, and global monetary competition. For crypto markets, the move signaled a transformation that would eventually push digital assets out of their speculative shadow and into the center of America's financial architecture. When you combine private accumulation, corporate partnerships, token revenues, and an executive order pushing toward crypto reserves, a pattern emerges that professionals cannot ignore. Money, especially at this scale, does not scatter randomly. It consolidates around a thesis. And that thesis, based on observable behavior rather than speculation, appears to be this: crypto will become a structural part of America's financial future, and those who position early will shape the rules. That idea becomes even clearer when examining the role of World Liberty Financial, a crypto project tied to the Trump family. According to Reuters, over $463 million of the Trump family's crypto income came directly from token sales associated with this ecosystem. That level of inflow places the project well beyond the category of a niche digital asset. It functions more like a hybrid between a political fundraising engine, an investment vehicle, and a digital asset experiment blending private and public influence. Professional analysts read this not just as a financial story, but as a governance story. If a political family can generate nearly $500 million from token sales, the lines between influence, policy, and finance become difficult to separate. This is where regulatory concern enters. In mid-2025, U.S. senators publicly questioned whether foreign entities, including actors tied to sanctioned nations, were using crypto platforms to gain access to Trump-associated ventures. NK News, a respected investigative outlet focused on North Korean financial behavior, reported concerns that individuals connected to the country had attempted to exploit loopholes within crypto frameworks tied to Trump-linked entities. Whether or not those attempts were successful, the existence of such concerns demonstrates how vulnerable digital assets are to geopolitical exploitation. And when a political figure is financially connected to such platforms, the national security implications intensify. Professionals in finance understand that markets don't respond to personal drama. They respond to systemic signals. The systemic signal here is simple. The United States is entering an era where crypto will directly intersect with policymaking. That intersection will not be smooth. It will create volatility, regulation battles, tax changes, institutional shifts, and political divides. But it will also create opportunity. And opportunity is exactly what attracts large capital flows long before the public understands why decisions are being made. Most retail investors believe crypto is driven by hype. Professionals know it's driven by liquidity, incentives, legal frameworks, and global monetary competition. When a political figure embeds themselves in the sector, the liquidity shifts. Regulatory incentives shift. Legal frameworks shift. The global monetary environment shifts. And when governments begin considering digital asset reserves, the entire concept of money starts to evolve. Dollars, treasuries, and crypto suddenly occupy the same mental space for institutions making allocation decisions. This matters for everyday Americans more than any headline can express. If the government begins holding crypto as part of reserve strategy, pension funds and retirement plans will eventually be pressured toward digital exposure as part of diversification mandates. That means millions of Americans may one day own crypto indirectly even if they've never touched an exchange. If stablecoins become more regulated and more integrated into the banking system, traditional banks may adjust deposit strategies, lending models, and liquidity management. That affects the mortgage market. It affects credit card rates. It affects small business lending. The shift is not confined to digital wallets. It touches the entire credit ecosystem. Taxation is another area where Americans will feel the shift. Crypto lobbyists have aggressively pushed for regulatory clarity, including exemptions for small transactions. If crypto becomes easier and cheaper to use, more transactions will move off traditional financial rails. That reduces certain types of tax revenue and may force the government to adjust elsewhere. Financial systems never lose revenue. They redistribute the burden. If crypto gains become easier to protect from taxation, other taxpayers may absorb increased pressure. The international implications are even bigger. Nations like China, Russia, and Gulf states have explored alternatives to the U.S. dollar in cross-border transactions. If the United States begins embracing crypto reserves, other nations may accelerate their own digital asset strategies. A world where nations hold crypto alongside dollars introduces new volatility into foreign exchange markets and reduces America's control over global monetary systems. And if the dollar loses even partial dominance, the cost of borrowing increases. Borrowing costs influence everything: federal debt, state budgets, consumer credit, housing affordability, and the daily cost of living. The crypto involvement around Trump is not an isolated event. It is a signal of a new phase in money, one where political power and digital assets merge. This merging creates both opportunities and risks. The opportunity is that America may lead in the global digital asset economy. The risk is that political influence tied to crypto could destabilize markets or create conflicts of interest that erode financial trust. For the ordinary person trying to understand what comes next, the answer is uncomfortable but clear. Money is changing, quietly, gradually, structurally. And the early signs are easiest to see not in speeches or campaigns, but in the flow of capital around those who expect the change before it arrives. That is the true significance of Trump's crypto connections. Not the income, not the headlines, but the signal that the next evolution of America's financial system may already be in motion. The deeper you look into the financial behavior surrounding Trump's crypto involvement, the more one thing becomes clear. The story is not about headlines or personalities. It is about incentives. Incentives shape markets more reliably than news cycles ever have. And the incentives behind Trump's digital asset moves point to a future where crypto is not a speculative playground, but a structural component of the American economy. To understand that future, you have to examine not just what money is doing, but why the people closest to policy are positioning themselves the way they are. The first layer of understanding comes from observing institutional behavior. Large institutions, banks, hedge funds, sovereign wealth funds, pension systems, are not emotional participants in markets. They respond to regulation, liquidity, and risk. When an administration signals friendliness toward crypto, one of the earliest shifts happens quietly inside risk departments. Analysts begin running scenarios on what happens if digital assets gain regulatory clarity. They model potential yield opportunities if tokenized products enter mainstream markets. They consider exposure strategies for stablecoins, custody structures, and digital settlement rails. This process doesn't show up in news coverage, but it shows up in capital movement. And since late 2024, those movements have increased. The second layer is geopolitical. Crypto is not just a financial tool, it is a strategic asset in global competition. The United States, China, Russia, and the European Union have all quietly advanced digital asset strategies in the last 3 years. China built a central bank digital currency and deployed it domestically at scale. Russia began exploring crypto rails to bypass sanctions and international restrictions. The EU pushed forward regulatory frameworks for stablecoins and tokenized financial instruments. The United States, long cautious, had remained on the sidelines until the executive directive that pushed government agencies toward a digital asset reserve. When a country moves from watching crypto to holding it, the geopolitical dynamics change. The shift suggests America intends to remain competitive in the next era of global finance, even if it arrives through unexpected channels. The third layer is regulatory leverage. Every industry that becomes heavily regulated transforms into a gatekeeping arena. Crypto is on the edge of such transformation. If a policymaker leans toward digital assets, the regulatory posture of agencies shifts. Enforcement priorities vary. Tax guidelines become clearer. Market participants gain more confidence to take long-term positions. And when large investors sense that regulation may become favorable, they deploy capital far earlier than the public realizes. This is why the partnership between Trump-linked entities and major crypto platforms was not just a business collaboration. It was a signal. If policy becomes crypto-aligned, the companies positioned early stand to benefit disproportionately. But the fourth layer is the one most people overlook. The financial system itself is evolving because traditional structures are reaching natural limits. Public debt is high. Monetary policy tools are less effective. Global liquidity cycles are more complex than they were 2 decades ago. And in environments where old tools lose effectiveness, new tools emerge. Crypto is one of those tools. Not because it's fashionable, but because it represents a parallel financial infrastructure with global reach. The question is not whether it replaces the dollar. The question is how deeply it integrates into existing structures. This integration begins in the private sector. Tokenized assets are gaining momentum because they allow for faster settlement, lower costs, and more transparent ownership records. Banks have quietly tested tokenized deposits. Real estate developers have explored tokenized property shares. Funds have experimented with tokenized treasuries. When a political administration signals support for this evolution, adoption accelerates. Corporations don't wait for speeches, they wait for frameworks. And once the frameworks appear, they move immediately. This is where Trump's role becomes uniquely influential. His involvement in crypto ventures creates a feedback loop. The more he engages with digital assets, the more aligned industries prepare for favorable policy. The more industries prepare, the more capital flows into the sector. And as capital flows increase, the incentive for policymakers to embrace digital asset infrastructure becomes even stronger. The result is a reinforcing cycle that pulls crypto further into the core of American finance. For the everyday person trying to understand why any of this matters, the answer lies in how financial systems translate institutional shifts into household realities. Consider the credit market. If stablecoins or tokenized instruments become widely accepted for settlement, banks can reallocate capital more efficiently. That efficiency could reduce certain lending costs or accelerate the approval process for consumer and business loans. But the reverse is also true. If banks lose deposits to crypto platforms offering higher yields, they may tighten lending standards or increase rates to compensate. That affects mortgages, auto loans, and credit cards, core pillars of household finance. Another area of impact is employment. If the digital asset sector expands aggressively, demand for blockchain engineers, compliance officers, digital asset analysts, and cybersecurity specialists will grow. Entire sub-industries, tokenized real estate, digital payment rails, smart contract auditing could emerge as stable employment sectors. But at the same time, automation inside financial institutions may accelerate, leading to restructuring in traditional banking jobs. This transition creates winners and losers, and the political alignment with crypto will influence how quickly it unfolds. Taxation will also undergo a shift. One of the biggest pain points in crypto adoption has been unclear tax treatment. Lobbyists have pushed for simpler rules, including exemptions for transactions under a certain value. If these changes occur, millions of small transactions, tips, micro-purchases, international remittances could move into digital asset rails. While that reduces friction for consumers, it also reduces revenue from traditional payment systems and potentially from taxable events. Governments compensate for revenue disruptions by adjusting tax policy elsewhere. That means shifts in where Americans feel financial pressure. Then there is the issue of financial stability. Crypto markets have experienced extreme volatility in the past, and integrating them into the national financial architecture introduces a new category of systemic risk. If banks or pension funds begin holding digital assets under looser regulation, a sudden market correction could affect balance sheets. And when a political figure benefits financially from certain crypto ecosystems, oversight may become politically sensitive. This creates a potential conflict between private incentives and public stability. The concern isn't theoretical. It has already been raised in congressional discussions about Trump-linked ventures. But not all consequences are negative. Some can be transformative in beneficial ways. A well-regulated digital asset environment could reduce transaction costs for businesses, enable faster cross-border payments, and give consumers access to new financial tools. Tokenization could democratize certain investment opportunities by lowering minimum thresholds for participation. A government-backed crypto reserve could strengthen American competitiveness against nations exploring alternatives to the dollar. The challenge is ensuring that the system is built for stability rather than short-term gain. One of the most overlooked aspects of Trump's crypto involvement is what it reveals about the future of political fundraising. Token economies tied to political figures blur the line between fundraising, investment, and community participation. A token that increases in value based on political momentum introduces a new model of financial engagement. It becomes possible for supporters to invest rather than donate. But this raises serious regulatory questions. When support becomes speculative, political momentum becomes financially leveraged, introducing volatility into democratic processes. Foreign involvement magnifies that concern. Reports of individuals tied to sanctioned countries attempting to interact with Trump-associated crypto ecosystems alarmed several policymakers. Even if these interactions were limited or unsuccessful, the attempt highlights how digital assets can bypass traditional financial controls. Maintaining integrity in political finance becomes significantly more challenging when intermediaries are decentralized and cross-border flows are difficult to track. This is why the scrutiny around these issues has intensified. For households and investors who ignore these developments, the consequence will be confusion when the financial landscape shifts. For those who understand them early, the next decade of financial opportunity will be shaped by awareness of these patterns. Crypto is no longer a speculative corner of the market. It is a competitive space for global capital, a field of political influence, and a potential pillar in America's future economic strategy. The most important reality is this: when powerful figures position themselves early in an evolving financial system, it is rarely due to curiosity. It is anticipation. They see structural shifts before they are visible to everyone else. They see where money is going, not where it has been. And the scale of capital involved in Trump's crypto network indicates a belief that digital assets are not temporary trends. They are part of an irreversible transition. The next phase of this story will not be about income reports or token launches. It will be about how deeply digital asset infrastructure embeds into the American economy, how global markets respond, how regulators adapt, and how ordinary families experience the consequences through interest rates, taxes, employment, and financial stability. The intersection of political influence and digital finance is no longer hypothetical. It is already unfolding, and its impact will define the financial direction of the country long after the headlines fade. The final layer in understanding Trump's crypto involvement is not financial, regulatory, or geopolitical, it's structural. It's about how systems evolve when powerful participants decide the old frameworks are too slow, too rigid, or too weak to handle where the world is heading. Every major financial shift in U.S. history has begun this way, not with a public announcement, but with quiet repositioning by those who anticipate change long before the public does. Crypto is no longer a fringe asset. It has become a testing ground for the next phase of American financial strategy. And the scale of Trump's participation signals that the shift is further along than most people realize. To understand this, imagine the U.S. economy as an engine that has been running on the same core components for decades. Treasury bonds anchor global stability. The dollar underpins trade. Banks manage deposits and credit. Regulation follows predictable paths. Markets respond to familiar signals. But engines wear down. They require upgrades, new systems, and new materials. Traditional finance is reaching the limits of what it can solve alone. High public debt, global competition, fractured supply chains, shifting demographics, and declining trust in institutions are all pressures the existing system wasn't designed to manage. Crypto, whether people like it or not, offers tools that the old system can't replicate easily. Programmable money, global settlement without intermediaries, publicly verifiable ownership, tokenized collateral, distributed liquidity, and new models of capital formation. Policymakers and institutions may not trust the culture of crypto, but they can't ignore its capabilities. And when someone like Trump, with the influence to accelerate or block entire industries, begins embedding himself financially into those capabilities, it signals which direction the shift might take. But shifts like this never happen cleanly. They happen through tension. The tension between innovation and control. The tension between public trust and private incentives. The tension between regulation and speed. And the most powerful tension of all, the tension between national interest and political interest. Trump's crypto involvement sits at the intersection of all these forces. Behind the income reports, partnerships, and investigations is a deeper trend that professionals are watching closely: the merging of political power with digital asset infrastructure. This merging poses risks that the average person doesn't see but will eventually feel. When political influence shapes financial ecosystems, market integrity becomes harder to maintain. Investors begin pricing in political outcomes rather than fundamentals. Tokens tied to political figures move like binary bets on election cycles. Foreign adversaries may seek to exploit decentralized networks to influence U.S. politics indirectly. And the American financial system, built on the principle of neutrality, is pulled into ideological territory. But the situation is not purely negative. There are structural opportunities hidden within this tension. If the government embraces well-regulated digital assets, America could lead the next global monetary race. The dollar's influence could extend into digital rails, giving the U.S. new leverage in international finance. Tokenization could modernize outdated financial infrastructure, lowering costs and increasing speed for households and businesses. A U.S.-backed crypto reserve could attract foreign capital seeking stability. Crypto-based fundraising models could create new forms of engagement. The key question is not whether these outcomes are possible, but under what conditions they emerge. A major factor will be how regulators respond. For years, digital assets existed in a regulatory gray zone. Agencies issued warnings, not frameworks. Courts defined classifications case by case. Investors had little clarity. That uncertainty discouraged institutional adoption, and uncertainty is toxic for financial markets. But when a presidential figure participates in digital asset ventures, the pressure to formalize regulation increases dramatically. Regulators can no longer treat crypto as a fringe issue. They must define rules for custody, taxation, token issuance, stablecoins, consumer protection, and oversight of political-linked crypto networks. And once those rules exist, the sector transforms overnight. Institutional money enters rapidly once the rules stabilize. Pension funds, insurance companies, asset managers, banks, and sovereign wealth funds all require clarity before allocating. But when clarity arrives, capital floods in. That is likely one reason Trump-linked ventures position themselves early. In markets, certainty is more valuable than opportunity. If the administration provides the certainty, the opportunity follows naturally. Professional investors understand this pattern because it has played out dozens of times across industries, from energy to telecom to biotech to fintech. Crypto is simply the next frontier. Another factor shaping the future is how Americans emotionally perceive money. For decades, money has been physical or digital but centralized. Banks hold it. Governments control it. Regulations define it. Crypto challenges that structure by distributing control across networks rather than institutions. Some see that as liberation. Others see it as chaos. Political involvement magnifies both reactions. Supporters may view Trump's crypto engagement as forward-thinking, adaptive, and strategically modern. Critics may view it as reckless, conflicted, or destabilizing. But regardless of interpretation, the effect is the same. Public awareness intensifies, and the role of digital assets expands. For everyday Americans, the practical impact will reveal itself slowly but consistently. Payment systems will integrate more digital rails. Remittances will get cheaper. Asset ownership may become tokenized. Borrowing may change as banks adjust deposit behavior. Investment portfolios will include more alternatives. Tax authorities will introduce clearer digital reporting. Businesses will adopt blockchain-based systems to compete. Over time, the financial landscape will look different, even if the average household doesn't fully understand why. But the biggest impact of all may be generational. Younger Americans are already more comfortable with digital assets. For them, crypto is not an exotic frontier, it is a normal part of financial life. Older generations control most of the wealth but remain skeptical. As wealth transfers from one generation to the next, the adoption curve accelerates naturally, and political involvement accelerates it further. By embedding digital assets into policy, leadership sends a message that the next era of finance won't look like the last one. This generational shift will do more to solidify crypto's place in the economy than any single executive order, partnership, or investigation. For the markets, the key question becomes how to price this transition. Markets hate uncertainty, but they thrive on anticipation. Trump's crypto involvement introduces both. Investors must now consider not only the fundamentals of digital asset technology, but also the political environment that will shape its future. Tokens associated with political figures will carry unique risk profiles. Companies partnering with Trump-linked ventures may attract both capital and scrutiny. Exchanges integrated into these networks may experience regulatory shifts, and global competitors may adjust their strategies in response to America's new direction. The real story, though, is not about Trump as an individual. It's about what his involvement represents, a turning point where crypto moves from the margins of finance to its center. Whether people support or oppose him, the signal is undeniable. When someone with influence, capital, and global attention positions themselves so deeply into an emerging financial system, it means that system is no longer emerging. It is evolving into its next phase. And that evolution will shape America's financial trajectory long after the headlines pass. Markets will adjust. Institutions will adapt. Policies will shift. Households will experience the effects indirectly through lending, saving, investing, and taxation. The transformation won't be explosive. It will be gradual, steady, and structural, just like every major financial transition before it. The story of Trump's crypto connections isn't about wealth or controversy. It's about a signal that money is changing, a signal that the architecture of American finance is entering a new chapter, a signal that digital assets are becoming part of national strategy rather than speculation, and a signal that those who understand the shift early will navigate the future more effectively than those who dismiss it as another political headline. Crypto isn't the end of traditional finance. It is the extension of it into a new domain. And Trump's involvement, whatever its motivations, has accelerated that transition. Whether the outcome is stability or volatility will depend on how the country manages the integration. But one thing is certain: the next decade of American finance will not look like the last one. And the movements happening now, quietly but decisively, are shaping that reality in ways the public hasn't yet fully recognized.